for JSW Cement, revenue has come in slightly ahead of what the street was working with a growth of about 22% that the company has reported on a year-on-year basis. But margins have come in at 15.8% versus 20% that the company reported same time last year. Let's talk about each of the parameters. And first, volume growth. We have seen a volume decline of 5% on a sequential basis. That, of course, is because of monsoon and other seasonal factors. But on a year-on-year basis, volume growth has been very strong at about 15%. Another factor which aided numbers was higher realizations because of higher cement prices both on a sequential and on a year-on-year basis. So realizations have risen by 6% QOQ and about 1.5% on a year-on-year basis. Volume growth was driven by a higher volume across regions and also because of ramp up in the north region. So that was one of the factors which aided very strong volume growth on a year-on-year basis. Costs meanwhile have risen. This is one factor which impacted the entire industry. Higher energy and fuel prices weighed heavy on the margins this time around, which is why we are seeing a margin contraction for JSW Steel. Net debt meanwhile has also risen by about 6% on a sequential basis to come in at 3,600 crores. We'll get more details in the con call, but for now, revenues are slightly ahead of what the street was working with. Volume growth was strong, realizations were strong. However, costs went up, and that perhaps will likely ease down over the next few quarters.